Welcome to our lesson on profitability and liquidity. Here we'll learn about the difference between liquidity and profitability and how we can calculate liquidity and profitability ratios. Let's dive in. First, let's consider the terms cash and profit. While they might sound alike, cash and profit are distinct. Cash refers to the actual money a business has at hand. It's what's in your bank account or physically in your till or safe, used to pay for operational needs like bills and taxes. Profit, on the other hand, is the result of subtracting expenses from revenue. However, revenue can sometimes include money yet to be received, like from credit sales. Here's why they matter. While cash ensures your day-to-day operations go smoothly, profit lays the foundation for the business's future growth. But what about the terms liquidity and profitability? Well, liquidity is about how quickly a business can access cash to settle short-term debts. It takes into account both the cash at hand and assets that can be readily converted into cash. Profitability dives deeper, examining how efficiently a business generates profit in relation to its sales. It's not just the sheer amount of profit, but how it compares to the total sales. We can calculate the profitability of a business using a profitability ratio. This is the profit percentage relative to revenue. So 50% means for every £1 of revenue, 50p is profit. There are two different profitability ratio methods: gross profit margin and net profit margin. Gross profit margin highlights the value of each sale to a business. It's calculated as gross profit margin equals gross profit divided by revenue, multiplied by 100. This ratio can point out if you need to adjust sale prices or reduce production costs. Net profit margin incorporates all business expenses, not just production costs. It's calculated as net profit margin equals net profit divided by revenue, multiplied by 100. If the net profit margin is lower than expected, it might be time to scrutinize your operating expenses. A liquidity ratio is a method of calculating the liquidity of a business. A liquidity ratio is always expressed as a proportion of 1. So, for example, a ratio of 2 to 1, which means that our current assets are double our liabilities. There are two different liquidity ratio methods: the current ratio and liquid capital ratio. The current ratio shows the enterprise's ability to pay off its current liabilities using its current assets. It's calculated as current ratio equals current assets divided by current liabilities. A higher ratio is favorable to a lower ratio, so a ratio of 3 to 1 would be better than 2 to 1. A ratio of less than 1 to 1 means that you are not able to pay your current liabilities. Liquid capital ratio differs by only considering the enterprise's most liquid assets. It's calculated as liquid capital ratio equals current assets minus inventory divided by current liabilities. Here too, a higher ratio would be better than a lower ratio, and a ratio of less than 1 to 1 means that you are likely not able to pay your current liabilities. In conclusion, cash refers to the money that the enterprise actually has available. Profit is revenue minus expenses. Liquidity is how quickly an enterprise is able to get access to the cash required to cover its short-term debts. Profitability is about how effectively a business is producing profit. A profitability ratio is a method of calculating the profitability of a business. There are two types of profitability ratio: gross profit margin and net profit margin. A liquidity ratio is a method of calculating the liquidity of a business. There are two types of liquidity ratio: the current ratio and the liquid capital ratio.